In this lecture we are going to analyze a Euro-Pound 1-hour chart with an example that uses an especially limited amount of price information, which serves the purpose of showing you how you don't need to look at what happened in the distant past to see what's going on in the market. What I mean by distant past is of course relative to the timeframe we use to trade. As a rule of thumb, you should be able to see the candle's nuances. If you are going back more than 150 or 200 candles, you are probably going back too far in your chart. This example is a little special because we are just looking at about 50 candles back. We are going to be looking at yet another manipulation maneuver that functions within our well-established tridimensional axis. By now you must be getting used to the idea that pretty much all market manipulations work under this paradigm. If you look at the price action before number 1, you will be able to see a normal flowing market that is not subjected to any sort of manipulation. It's obviously an upward market up to number 1, and that gap reinforces that notion. Once again, we can see this as an uptrend by looking at the major flow marked by short and thick black horizontal lines. From point number 1 onwards, things start to change a lot in this market. If you are the sort of trader that is not aware of how large traders play in the market, you would have a really hard time understanding what's going on from point 1 onwards. This would inevitably result in confusion that would later result in a lack of confidence to trade. Traders tend to fear what they don't understand, so the key to eliminating fear is studying the subtle mechanics involved in the market. Let's go through the mindset of a breakout trader in this market for a moment. If you find yourself around number 1, your last long trade near the bottom left corner of the chart probably worked out well, so now you are confident you can make the same thing again when price breaks the high number 1. That gap also adds a little more hope to your idea of getting long at the break of high number 1. When you see the wide bullish candle right after low number 2, you are almost certain that this market will shoot up like a rocket, and that you would be foolish to waste this opportunity. This exact moment is what we call the von Restorff effect in the methodology that you are learning in the course. In other words, large traders purposefully bring attention to a single point in the chart to make retail breakout traders extremely confident and hopeful. Let's also notice that since there are many retail breakout traders in the market thinking along the same lines, there is a dense cluster of buy orders sitting at the level of high number 1. You are probably already aware that large traders will pierce that level to trigger that cluster of orders, and that will create a deep liquidity pool. Let's also examine exactly what that means, and the mechanics that surround this idea. When a dense cluster of orders is triggered, it means that there is a huge opportunity for other market players to take the opposite position. In this specific situation, when many buy orders are triggered, a huge selling opportunity appears simply because there are too many people buying. That's simple supply and demand mechanics. The thing is that large traders can often overpower masses of retail traders, and that's what candle number 3 is all about. Candle 3 is the triggering of a cluster of orders to generate an opportunity for large traders to get in the market in the opposite direction. Notice that large traders overpowered retail traders and made that candle close below the high number 1 level, and also close near the absolute low of the candle 3 itself. This candle sends a clear message to the retail breakout traders, and that message is that they were mistaken about the market. This is exactly where the reverse psychology process begins to take place because many of those retail traders are already stopped out since they place stop-loss orders that are too tight. The ones that are not yet stopped out begin to close their orders manually out of desperation. Don't forget that while all of this is happening, large traders are in control of a massive sell position, and what happens next just helps this large position to get even bigger. After number 3, when people see price starting to fall, they start to jump into the bandwagon to the downside so to speak, and that's the tridimensional axis working in full circle. That explains the method of maneuvering retail traders, but it does not explain how an observer of the markets would actually take advantage of this situation. This is where clever line work in the charts can make the difference. You will often see price coming back to the wash line, and that's an excellent opportunity for us because we can take advantage of that to trade with a good risk-reward ratio around these manipulations. Beyond that, other types of line work in the chart that point to the same area can also be extremely useful to trigger trades, but that's something that requires some experience with precise line drawing. Observe that in number 4, price made a lower low than number 2, and this makes high number 3 a solid market structure. Notice how high number 3 is probably the most important point in this chart since it is a solid structure and also the main axis of the manipulation maneuver. All of this means that if price comes back near the wash line, price will be exactly in a sell zone, which is something that would represent a perfect selling opportunity in this context. In this lecture I want to show you an advanced way of getting into a trade like this using the clever use of lines. Observe that I drew a green line starting from number 2 and extended it to number 4 to catch the angle of the new market axis. One logical technique to pinpoint an opposite market edge is to use the same angle in the previous and opposite market extreme. In other words, by using the angle discovered in the lows number 2 and 4 and extending it in high number 3, we can sometimes foresee the next market edge. This only works in specific situations when you have other elements pointing to the same area, which is exactly the case here since we have a wash line pointing to the same market level roughly speaking. The way to trade these lines is obvious. Since we are dealing with a sell trade opportunity, which agrees with the large trader's position in this market, we can place a sell limit order at the wash line, or we can place a sell limit order at the upper green line. In this case I placed the sell limit order at the upper green line and I got filled almost exactly at what appears to be a reversal point in the market. The stop loss was placed above the upper tail of candle 3 because it is the main axis of the whole market manipulation in place. The target was placed at the upper limit of what I called the subjective buyer's point of ignition in the lower portion of the chart where I drew the red rectangle. Observe the origin of that rectangle and you will notice unusual lower tails indicating buying pressure just before price took off in a massive bullish candle marked by the vertical line. That's an unusual trade with a risk-reward ratio of almost 1 to 10, but we have good logical reasons to believe this will turn out to be a successful trade. It's not merely an arbitrary choice. Let's take a look at how this market played out. Here we can see that price reached our target, rendering our trade as a victory. Notice also how the red rectangle is now creating a bump in price after a significant drop just to confirm the notion of the subjective buyer's point of ignition.